Hello, welcome back to our conversation on the cash flow statement. We'll continue to understand the cash flows by observing business decisions and converting those decisions into financial statements and deriving the different cash flows as required by the Ind AS 7. And so for that, let us take an example here. So we have a set of very simple transactions. The objective is to convert these transactions into the financial statements. And while preparing the financial statement, observe we are just finding all receipts minus all payments. Then we will classify these receipts and payments into cash flow from operations, investment, and financing. So now let us move ahead. So this is a balance sheet, financial statements of a company, A Limited, and they buy and sell everything. So therefore, this concept of capital goods and revenue goods and operating goods, you have to be careful about it. So they started business with cash. So the company receives capital. Company receives capital 50,000, and that is a source. The face value of that shares is 10. So the number of shares the company has issued is 5,000. The company availed a 10% loan is a receipt, and the amount of the loan is 500,000, and loan is a source, is a liability. So till now there is a receipt, no income, but capital and loan. Purchase furniture for the office. So purchase furniture for the office obviously is not an operating goods, and the value of the furniture is 50,000. And the purchase, nothing is mentioned. We will assume that the furniture has been purchased for cash. Purchase toys, so they buy and sell anything. They're buying toys and selling them. They're buying penny stocks and selling them. So therefore, they buy and sell anything. So purchase penny stock is an acquisition of asset, which is an operating asset, and they did not buy it on cash. They purchase that on credit. So therefore, there is a creation of an asset has resulted in creation of a liability, or acquisition of asset has resulted in the creation of a liability. Purchase penny stock for cash. So we will say that with respect to toys, they did not pay any money. And intentionally, I'm showing the payments here, even if there is no payment, because our focus is to understand the cash flows. Purchase penny stock, and purchase of penny stock has resulted in outflow of cash and creation of asset. And for this example, for this company, both toys and penny stock we treated as an operating goods, because they buy and sell anything and everything. Now, they're selling 20% of the penny stock. They're selling 20% of the penny stock for they're selling for 15,000. Sold 15,000. How did we get 15,000? You can see that there are 20,000 value of penny stock. That means the 5,000 penny stock is there. So the number of penny stock purchase, penny stock purchase is equal to 5,000. It's given 5,000, and we are selling now 20%, 0.20, so 1,000, and we are selling that for 15 rupees per penny stock. So the value of the sales is 15,000. Is it for cash? Yes, there is a receipt and this is an income. But because of the matching principle, there has to be corresponding cost of the penny stock sold. And the cost of the penny stock sold is equal to 1,000 at the rate of 4. So 4,000. So what is the value of the penny stock left now? The penny stock left will be 16,000. Let us recap that. So we can see that the company purchased penny stock by paying 20,000. They sold 4,000 worth of penny stock for 15,000. And this 15,000 is a cash inflow. And so therefore, it's an income and a cash inflow. Then they sold 30% of the toys for cash, 30% of the toys for cash, and so the cash received is 250,000. If the company has received cash, so there will be no receivable because the entire sale of toys has been for cash. So we can recap that the sale of toys is for cash, so there is no receivable. Income received is a cash inflow. Income not received is an asset in the form of receivable. But once again, because there is a sale, there has to be cost of the goods sold, which is the cost of toys, and the cost of toys is equal to 90,000. How did we get 90,000? It is 30% of the goods sold, or 30% of the toys purchased, and the toys purchased were 300,000. Salary to the salesperson is an expense. Salary is an expense and a payment. So we assume that the salary has been paid. Transportation cost is an expense and there is a payment. We will also assume that the transportation cost has been paid. Expense paid is an outflow of cash. Expense not paid is a liability. Similarly, we have to, though it is not mentioned, but because of the accrual principle, we should also remember that interest is an expense and interest has to be shown. Whether it's mentioned or not mentioned, we are required to show that interest. So interest is, let us make the interest for the year. So therefore, interest will be 60,000. Okay, so interest paid is an cash outflow. Interest paid is a cash outflow. And so therefore, no interest payable. Okay, expense paid is a outflow of cash. Expense not paid is a liability. So in this case, there is no interest payable because we have paid that. Now all the transactions have been taken care, all the expenses and all incomes. So if you know all incomes and all expenses, we can derive profit. Profit will be income minus the expenses. Expenses is 184,000. The income is 265,000. So PBT is equal to 81,000. Tax is 25%. So tax will be 25% of PBT. Unless specifically mentioned, we always calculate the tax on profit before interest and before tax. And let us pay the tax also. Let us pay the tax, and the tax payment is an outflow of cash. If not paid, we would have shown that as a liability. So PBT minus tax is PAT. PBT minus tax is PAT. And whenever there is a PAT, there is a decision to be taken. The company has to take a decision what to do with this PAT, whether to distribute as a dividend or to retain that as a profit. And here it is already given that the company has decided to retain the profit. So dividend is 0. If the dividend is 0, of course, you are not required to write anything, but for the sake of discussion, so I'm showing dividend is 0, no payment. If no payment, so the entire profit will become retained profit. Entire profit is transferred to the balance sheet as a source. So profit is income minus expenses. Retained profit, which is PAT minus the dividend. So we got the PAT. Now let us find cash in hand. Cash in hand is equal to cash available minus the cash payments, minus the cash payment. So cash in hand is equal to 634,000. Cash in hand. So what to do with this cash in hand? Cash in hand is an asset. So cash in hand will be transferred to the balance sheet. So let me reiterate two important items on the balance sheet, that is the retained profit and cash in hand are dependent on the income statement and cash flow statement. This also tells us that the financial statement, balance sheet, income statement, and cash flow statement are interrelated and interconnected. So the total of the assets, okay, should be equal to the total of the sources, okay, and because we know that there will be cash, and if asset is there, there has to be a corresponding source. There has to be corresponding source. Let us check here. So there is a difference here. We can observe that 110. So 90,000. The cost of toys, yes, the toys value should have come down. Okay, so in case you see that balance sheet is not, it is not possible, right? Because we know that sources will be equal to the assets, and the sources are in this example it is 910,000 and supported by the corresponding assets. The corresponding assets are 910,000, or other way around, we'll say the assets are 910,000 supported by the corresponding sources. And what are the corresponding sources? The corresponding sources are equity, which is capital plus reserves, liabilities, which is loan, interest, and creditors. So at any point of time, we know that A will be equal to E plus L. So this is the first part of the exercise. So we found cash in hand. So cash in hand is equal to 634,750. But the accounting equation is also very clearly shows that at any point of time, the assets will be equal to E plus L. But the accounting standard Ind AS 7 says it is not enough to find the cash in hand. It is necessary to classify the cash flows into CFO, CFI, and CFF. Let us focus our attention only on the cash flow. Let us focus our attention only on the cash flows. The cash in hand is equal to 634. So according to the Ind AS, you need to classify the cash flows into operations, financing, and investment. So what is operating cash flows here? The operating cash flows are sale of penny stock, because they're selling and buying anything and everything. The sale of toys, so receipts from sale of penny stock, plus receipts from the sale of toys, minus the purchase of toys cost, minus the payment of the penny stock, minus salary, minus the tax is the CFO. So CFO in this example is positive. The company is having positive PAT and also positive CFO. But you observe that CFO is not same as PAT. We'll dwell into that a bit later. But we are at least able to see that CFO is positive and PAT is also positive. CFF. CFF is a cash from financing decision. And financing decision is the receipts from financing decision and the payments from financing. And what are the receipts from financing decision here? The receipts from the financing decisions are the capital and loan. The payments are interest and dividend, and of course the dividend is zero here. So therefore, the cash from financing decision is 490,000. Then that brings us to the cash from investment activity. There is no receipt from the investment activity. Neither the company received dividend, nor they sold any share or any other assets which are non-operating. In this case, we treat the penny stock as a part of their main business. So CFI is only purchase of furniture. So CFO plus CFF plus CFI is equal to cash in hand. Because it's a first year of business, so therefore there is no opening cash in hand. So cash in hand is equal to CFO, CFF, and CFI. The cash in hand is also equal to receipts and payment. But as I mentioned, the accounting standard is very particular that you need to classify all the receipts and all payments into financing, investment, and operating. Into financing, investment, and operating. But observe this, CFO is positive. But let us make a small change in this and understand. Let us go down. It is more or less the same question, okay, same information. And PAT is equal to 60,750. Here also, PAT is equal to 60,750. But observe, CFO is negative. So that is an important part. Same PAT, 60,750, 60,750. But, okay, sales are same. Most of the expenses, all expenses are same. Expenses are 184, 184. Income is 265, income is 265. PAT is 60,750, PAT is 60,000. But in the first case, we had a positive CFO. Now we are seeing negative CFO. So you can ask a question here that when the company is having profit, how comes cash from operations negative? And that we can see here. Whenever there is a possibility, whenever there is a negative CFO, it's possible that the company might have sold the goods on credit. Can you see that? Company has sold. Entire sales is on credit. What happened in the past? In the previous case, the receivable is zero. Entire sales was for cash. So it is possible that a company, any company, may be having consistent profit, but they may not be converting the profit into cash flow. So it is very, very important for us to observe both cash and the profit, and within the cash, the composition that CFO, CFF, and CFI. That is why the Ind AS is very particular that every company is bound to show the cash from operations, cash from investment, and cash from financing decision. Let us take an example. Let us see a real life company. This is Hindustan Unilever, the annual report of 2021-22, and I'm just showing the cash flow statement. First, observe. The cash flow statement shows cash from operating activity, B, cash from investment activity, and C, cash from financing activity. So every company is bound to show that. Now, what is happening to the CFO of HUL? The CFO of HUL is positive. In 2021, it is 8,957 crores. In 2022 is 8,964 crores. Cash from investment activity was negative. That means the company is buying assets, because you can see that purchase of investments, a big chunk of investments have been acquired during the year. Okay, and cash from financing activity of Hindustan Unilever is negative. So why it is negative? Because the company has not been taking big loan, or they did not pay any loan. They did not go for buyback of share, but the negative CFF is because of the payment of dividend. That means HUL is generating profit cash from the operations, using the cash to acquire assets and also distribute profit. So it's important for us to remember and understand that along with the income statement and balance sheet, cash flow statement is equally, if not more, important for an analyst. I repeat that profit is subject to assumptions. So profit can change because of the assumptions, whereas cash is a real item. So profit is surreal, cash is real. And we'll keep on examining this, the relationship between profit and cash. Thank you very much.